I wrote something for Money Marketing last year, one of my jobs, about one of the things I'm going to talk to you about. And the financial advisors like commenting on what I write. Yet another load of sensationalist codswallop, said Andy Crow. And Ted said, Paul, some people only think you're an idiot. Best not to open your mouth and confirm it. Thanks very much, Ted. My readers love me, and the people on Radio 4 do as well. The announcer the other day, I was waiting to do a trail, and the announcer said, and now, before Brain of Britain, here's Paul Lewis. So enjoy. And this is me. Well, it's an old picture. It's the only one I could find. And as Sven kindly said, 87,500 people follow my Twitter feed. And I do tweet a lot. And those of you who follow my Twitter feed, I'm sure that's the great majority here, at Paul Lewis Money, will know that on Wednesday, I went to Norwich. And I'm here today to bring you the results of what I discovered in Norwich. But you'll have to wait, because that will be the denouement. And that will come at the end, like denouements do. So, safe and simple in a dangerous and complex word. It's a bit of a mouthful, but I like saying things in very few words, so I love Twitter. If you can't say it in 140 characters, don't bother. So, safe and simple in a dangerous and complex world, how to protect your money and your future and take no risks. Honest, I mean it. No, really, there you are, 140 characters. And that's the entire talk. Because all those things, danger, risk, safety, that's what I'm going to talk to you about today. And I'm going to start with danger. I'm going to start with danger, theft, and fraud. Where do criminals go? Well, they go where there's money, don't they? And where is the money? Let me take you back to that exciting day, the 19th of March 2014, when pension freedom was launched. George Osborne, you remember, he was the man in 2012 who announced he was going to reduce the £100 billion budget deficit by charging VAT on pasties that were slightly warm. We mocked him then. But on Budget Day 2014, with this statement, no one was laughing. It's quite hard to laugh when your jaws hit the floor. And in the first 9 months of pension freedom, 213,000 people over 55 took advantage of the right to use their own money as they saw fit. And in those 9 months, £3 billion was taken out in cash. Now, over the year, it may total closer to £4 billion by maybe more than 250,000 people. And they wanted to use their money now, not in the future. And the Chancellor gave everyone over 55 the right to take out their pension savings as we want. And the former pensions minister at the time, Steve Webb, said he was relaxed if people spent their money on a Lamborghini. Though, as Michael Golbert of Buckinghamshire said in a letter to the Daily Telegraph, "Sir, blow my pension fund on a Lamborghini? I think not. Like most over 55s, even if I could get in one, I certainly wouldn't be able to get out." And few indeed will buy a Lamborghini. That low-spec Aventador up there, it costs £260,000. That's quite a pension pot. And at 18 miles per gallon, it's also expensive to run, especially if you can't get out of it and you have to drive round and round until you're rescued. But with an average pension pot of around £33,400, this is before pension freedom, you might be able to afford maybe, I don't know, a Ford Mondeo. But with the median pot, the middle one, half above, half below, that's £22,000. So really, I think we're talking a Fiat 500. It would be cheaper to run, but you'd have nothing for your retirement. Now, £3 billion, £4 billion, of course, the thieves are rubbing their hands. And who owns it? Older people. And you've seen the wildlife films, haven't you? Who's the one the lions go after? That one. The older, slightly lame one at the back who can't run as fast. So don't blame them for going after people who are able to be conned. But in fact, it wasn't the thieves who got the first helpings to this money. Let me remind you of the man who took the lion's share, that red quadrant. That's the Chancellor. He got £900 million of the £3 billion, three and a bit billion pounds. He got it That's his. He kept it. Chancellor George Osborne. People over 55 in blue, George Osborne in red. No wonder he's smiling. And even looking slightly amazed himself at the end there. So here's how it works, because people don't all understand this, I have to say. Now, as we all know, the first 25% of your pension lump sum is tax-free, more in some cases. The rest, though, is added to your taxable income in that year and taxed. And if that takes you above, this year, £43,000, you pay tax at 40%. In some cases, even more, 60% if you've got an income around about 100,000. Here's a couple of examples. Annual income, £25,000, pension fund 40, tax due, £8,523, vanished. Pension withdrawal, £75,000, annual income 40, tax due, £22,000. That's 29% disappears. And even worse, because HMRC likes to make sure any errors are on its side, it takes special rate of emergency tax. It, in fact, takes £23,759 and leaves you to claim back your £1,738. Many people haven't done that in the last year, as far as we know. But write down P53, that's the form you need. And Fidelity has a very useful calculator, the best one I know of, on its website, which actually explains all this to you. But you see what's happening here, don't you? Some people find they're paying into a pension throughout their lives and getting tax relief at 20%, but they end up paying tax at 40% when they take it out. Now, that is exactly the opposite of how pensions are supposed to work. The idea is you pay in when you're earning a lot, you take it out when your income is a lot less. The Treasury reckoned it would take £3 billion over the first 4 years, and these figures indicate it could be even higher. And don't tell me it's just tax brought forward. It's not. This diagram here shows you that it's not until 2031-32 that the Treasury actually starts losing money. So basically, it is making money for the next 15 years, and that really is the time horizon of any chancellor or government. And another tax raid is planned next April, when people will be allowed to cash in annuities, missold once in many cases, and the cash-in may also be missold. But again, one man will smile, because the lump sum that they will get for their guaranteed income for life will be added to income and taxed in 1 year. And that will put many basic rate taxpayers in the higher rate. There's £1.25 billion over 4 years expected to come to the Treasury from that. And some low-income annuitants, who actually, with the rising tax threshold, may not pay any tax at the moment, could suddenly find themselves propelled into higher rate tax. But of course, whatever you say about George, he's taking money legally. He makes the laws, after all, so he's bound to. And at least he only takes some of your money. Now, it used to be when we went out, when you go out of here, you lock your doors and windows, you come here, you keep your money safe in your pockets, you keep your eyes open. And we don't expect to be mugged. But now there's danger, not on every corner, but inside every home, your home and yours. Because we have willingly drilled holes and laid pipes into our homes, which can be used to suck our money out as surely as someone turned up with a diamond cutter. Sorry, that's George Osborne smiling again. I can't resist that. If someone turned up with a diamond cutter like they did in Hatton Garden. And unlike that theft, the people who rob us in our homes are very unlikely ever to be caught, still less to be punished. Let me introduce you briefly to Mark Bentley-Leek and Mustafa Dervish. They were the directors of Bentley-Leek Financial Management. They were regulated financial advisors, and they promised returns between 6 and 18%. In some cases, they ensured their customers' money couldn't be lost. Those promises were not true. The property they invested them in was in Dubai, Canada, Zanzibar. They also failed to inform customers that they were directors of the property companies that they recommended. More than 300 investors lost £35 million £115,000 each on average. They were fined, they were banned from financial services. They deny doing anything wrong, I must add that at this point. Their firms are in administration. The Financial Services Compensation Scheme is paying out because they were regulated IFAs. But it can only pay a maximum of £50,000 on these, less than half the average loss of the investors. And in May last year, the average claim was about 43 and only 140, less than half of them have got money. Property is a dangerous investment, especially outside the UK. Other dodgy schemes, carbon credit trading, green investments in Ecuadorian rainforests, sustainable eco-tourism in Congo, wine investments, and the sun is shining on solar panels, annual return 10%, real examples of offers being made at the moment. My inbox is filled with these every day. Some of these investments are in the category unregulated collective investment schemes, or I pronounce it UKIS, because very often you kiss your money goodbye with those. Secured Energy Bonds PLC, 900 investors put £7.5 million into bonds secured on an Australian company. They were, but then the Australian company went bust. They promised 6.5% building solar infrastructure in UK schools. Two of my listeners, one invested 8,000, another 5,000. A crowdfunding platform, Trillion, acted as a lead generator. It says now it is, quote, deeply disappointed. I'll bet it is. It may or may not get compensation from FOS. And this week, today, you missed it, you were here. You can hear it Sunday night at 9 o'clock on Radio 4 or on the website. We looked at an investment in what was called ethical forestry in Costa Rica. One listener put £18,000 into it, and it promised to turn that £18,000 into, over 24 years, into £1 million, a return of 18.5% a year. They got 600 fast-growing trees. When they were harvested, that money would be buy more trees, and after 6 cycles, you're supposed to get your £1 million. Earlier this year, the directors put the firm into administration. And over 2 years, 2013 and 14, their accounts show the directors had taken out £14 million from the company. The liquidator says there are some trees there. He hopes to sell the firm. One potential buyer, though, has warned it will endeavour to use all possible strategies to mitigate the investors' returns. In other words, they are not going to get their £1 million. They may, Christie and 3,300 others, may have lost everything. So the sharks are circling. And all these investments have returns that are way above anything that can be achieved. Be suspicious above 6%, say no above 8%. Some sort of implication of a guarantee, safety, return of capital. All those guarantees are untrue. They cannot be true. And they're all completely unregulated, though they don't always say so. Sometimes they say, all monies are transacted via an FCA-regulated payment platform. So when you pay, that guarantees the money you'll get to them, but it doesn't guarantee you'll get any of it back when things go wrong. Now, protecting yourself is quite easy. You wouldn't walk down the high street, would you, covered in £50 notes, or give them to this man who said he could double it and promised it was safe. So you have to stay safe. Be wary of cold calls. Assume they're a scam. If it's a cold call, say no. Is it overseas? A country you know nothing about? A foreign language? Foreign laws? What could go wrong? Everything. Say no. The regulator actually warns investing in overseas agriculture, like my ethical forestry, can be high risk, and they are generally not regulated. If something goes wrong and you lose some or all of your money, no way to get it back. Don't fall for guaranteed returns. Say no. And don't be rushed. If there's time pressure to sign up, walk away. Why are they rushing you? Next, what do you know of the market you're investing in? If it's in property rental, what do you know about that? If it's a green project, what do you know about sustainable forestry or solar power? If nothing, say no. And is there liquidity? Which means, can you sell that investment easily at any time? With stocks and shares, the answer is yes. With many of these things, the answer is no. And finally, don't fall for glossy booklets and smart websites. They are dead cheap. The lady who lost the 18,000, or may have done, in ethical forestry, she got share certificates of ownership. She got the GPS coordinates of all her 600 trees. She still may not get anything back. And of course, they all have one other thing in common. You shouldn't touch them with, well, as Marvin Gaye or Diana Ross may have said, ain't no barge pole long enough. So that's investing, that's the danger. The tax back for the Chancellor, the danger of thieves. So what is safe? I'm going to talk to you now about cash. I always get in trouble when I talk about this. I get very strong reactions, largely against things I never said. Let me be clear. In the long term, the place for your money is almost certainly in shares. Something simple, a tracker fund in the FTSE All-Share. A good, cheap tracker fund, leave it for 20 years, ignore the ups and downs of the stock market, just let it run. Of course, you can complicate it. You can go for emerging markets or Russian mining companies, also known as the FTSE 100, or African startups, or Eastern tech or currency funds, but they're all gambles on somebody else getting it right. Many financial advisors agree with me. What we disagree about is what is long-term. I say 20 years. Many advisors say 5, sometimes less. So what do the figures tell you? And now, the denouement. It's quite a long denouement, actually. I said earlier, I'd been to Norwich, a lovely town. I went there in search of figures that you cannot find anywhere else. Locked in a dusty library, not in the cathedral, it might have been, copyrighted by the people who collected them, and I was very fortunate to be given access to them by Moneyfacts, and I was allowed to use them. Now, I've been interested for a long time in whether stock markets are a good place for your money. When you ask that of an advisor, they give you various studies which show how shares, or equities as they like to call them, because it sounds a bit mysterious and grand, how shares and cash compare over a reasonably short time as investments. Now, the most famous and respected study of all is the Barclays Equity Gilt Study, published every year, published, in fact, about a month ago. And its results are absolutely unequivocal. Here are UK asset returns. I hope you can read them. Decade by decade, shares, equities, outperform everything else. And as for cash, well, they say it loses you money. It doesn't, because they've actually deducted inflation, but cash can't lose you money. But anyway, that's what they've done with all of them. Most people take one look at that and one look at the 10-year ones here, and they see cash is negative and bottom, they just write it off because they know returns are rubbish. We're always telling you returns are rubbish. Enough said. But like most similar studies, in fact, all studies I've come across, this one exaggerates the returns on shares and understates the returns on cash. Now, first, investment returns are exaggerated because they don't take account of charges. They look at the total return index. Those of you who are in Justin's presentation, that's the one he was using. Absolutely right, reinvest your premiums. And that gives you the miracle of compound interest as dividends are reinvested. But it doesn't take account of charges. Now, charges of even 1% can make the picture look very different. And even with the current low-cost trackers, charges should be taken into account for a fair comparison. So investment returns are exaggerated. Step 2, having exaggerated investment returns, you understate cash. Now, Barclays' study uses a now closed nationwide account, Nationwide Invest Direct. It pays 0.25%. Now, that's an improvement because in August 2014, it paid 0.2%. But even the average instant access account measured by the Bank of England was treble that in August, 0.62%. And that's a fraction of what you can get. The best at the moment is 1.45. So they use 0.25. 1.45 on instant access is the best you can get. Nearly, 6 times the figure. Now, Barclays says it uses that because it is, quote, more representative of building society returns. Yes, it is. But you exaggerate the return on shares by excluding charges and reduce the return on cash by using a poor return. No wonder shares win that rigged race. Of course they do. And it's not just Barclays. Hargreaves Lansdown issue figures, AXA Wealth issues figures, and they all do much the same. And guess what? All those businesses are interested in selling you investments. 30 years of journalism, I have learned, beware of research that promotes what the products the firm sells. In fact, my very favorite was a release I got years ago. Vitamin C is good for you, says Florida Citrus Fruit Council. It kind of sums it all up, doesn't it? So I wanted to see what a fair competition between cash and shares would look like. So step one, include charges. And I do that very simply by picking a real live tracker fund. FTSE 100 tracker, HSBC runs it, and Morningstar, the data company, kindly gave me data back to 1995, October 1995, 20 years before I started this research last October. But what of cash? The advice is, of course, keep your eye on rates, keep moving your money to the best account. I call that active cash. What return would you get with active cash? Now, to work that out, you need data going back to 1995, like the Morningstar data on the tracker. But while you can track the FTSE 100 back to when humans stopped having sex with Neanderthals, data on cash is very hard to find. The Bank of England does average rates back to 1996, but those are averages. The current average one-year bond on the Bank of England figures is a shade over 1%, but you can get nearly double that, 1.9%, by picking the table topper. So averages don't really do it. You can find current comparisons, of course, but historic ones do not exist in table form. Now, Moneyfacts has been compiling these since 1988, but their rates aren't available in digital form until 2007. So as I say, I went to Norwich, to the Moneyfacts office. They gave me their library copies of the old Moneyfacts, and I sat there with my laptop, taking down the numbers of saving selections, best buys, into a spreadsheet. And I now have the only digitized run of Best Buy cash over 20 years, the only one in the world, or at least the only one for UK. I don't know about anywhere else. Now, active cash means moving your money to the best account. Not every month. Let's say every year. You don't want to be too obsessive. And if you do that, you put money into a one-year bond. A year later, you take it out, you look at the market, you put it into the best one-year bond. Leave it for a year. Do that every year. Currently, as I said, the Bank of Bermuda will give you 1.9% over the next 12 months. Don't worry, it's called the Bank of Bermuda, and it's located outside the UK. It's in the deposit security scheme, the compensation scheme. And that's nearly 8 times the 0.25% you get on a nationwide account that Barclays uses. So I took down all these one-year bond figures from Moneyfacts. I didn't pick Best Buys for £50,000. Often it was just 500, never more than 2,500. And I did it every month from January 1995 right up to the present day. Very grateful to Moneyfacts. So how did I do the comparison? Well, it's very simple. What we want to know is at the end of, say, 5 years, do you have more money with cash or a tracker? That's all that matters. So you put £10,000 into a tracker, £10,000 into cash on a date, any date, pick a date, let's say September 2001. 5 years later, on September 2006, what are they worth? The actual tracker, you will have grown 25%, £12,487. The cash account will have grown 12 to 12,757. So cash wins just about. It's within sort of margins of error. Now, is that typical? So my research covered October 95 to October 2015, 20 years. And you can start your investment in any 5-year period. So you choose any month, October, November, December 95, July 97, February 2006, right up to October 2010. 182 I looked at eventually, 5-year periods. How many would show cash or shares ahead? Without allowing for tax, there we are. Without allowing for tax, the answer is shares win 74 times, cash wins 108 times. In other words, if in those 20 years you get a pin and you stick it in the calendar, 6 out of 10, 59%, nearly 6 out of 10, the chances are cash will have done better. Active cash will have done better than a tracker. 41%, 4 out of 10, shares will win. Now, if you deduct basic rate tax from that, it's still cash ahead, but not as much. But of course, from this year, no tax is due on the first £1,000 of saving, so you'd need 50,000 or so to have to worry about tax. And even in the past, it could have been in an ISA or tax-free NS&I product. So to recap, without tax, from 1995 to 2015, active cash has outperformed passive shares 59% of the time. And it gets worse for shares. Sometimes they don't just do worse than cash, they do worse than keeping pound notes in a tin box under the bed. There's less at the end than there was at the beginning. And that happens in 43 of those 182 periods. 24%, 1 in 4 nearly, times you will have lost money on that random 5-year investment. You never lose money with cash, of course, because it doesn't go down. Financial advisors are all shouting at this point, "Oh, yes, you can lose money on cash, you idiot. What about inflation?" Well, I'll tell you a secret. With inflation at 2% and cash making 1.5%, yeah, it's worth less in real terms at the end. But let me tell you something. Inflation affects investments just as much. If your investment grows by 1.5% and inflation is 2%, you have lost just as much on your investment as you have on cash. So my figures ignore inflation because it affects investment just as it affects cash. So my active cash system is simply this. Whenever you start, you look at the best one-year bond, you put your money in. Once a year, you reinvest it in the current best one-year bond. Not difficult. Review it once a year. There's a website called savingschampion.co.uk. They do best buy tables. I mention them because they're objective. They're independent of any relationship with the provider. If it's in there, you can be sure it is genuinely the best buy in that table. It will also look after your money if you want, but that's quite difficult. It charges you for that 0.2% a year, a bit more in the first year. And every time your savings fall below the best buys, it tells you. But then, although it can send you the forms, you have to do it yourself. Because the problem with cash is it's difficult. Active cash means moving your money to the best account. And one investment advisor, I said, "But no one does that, it's hard work." Well, it's not that hard, but prejudice against cash makes it much harder. Independent financial advisors generally, this general rule, many of them it doesn't apply to, generally don't know much about cash. They're not interested in managing it, that's for sure. And if they try to, there are barriers, far more barriers to letting someone manage your cash than letting them manage your investments. And that includes not just advisors, but the banks as well. And I know from talking to cash experts, few as they are, there are many people with very large sums, millions of pounds in some cases, who are risk-averse, who do not want to wake up and find their money is worth less, do not want to let an advisor quietly take a percentage, 1% of it every year. They are in cash. Let me look at those 20 years from October 95 to October 2015 again. The tracker produced an annualized return of 6.01% compound over that period. 6.01. The cash, the active cash, moving it every year, produced an annualized return of 5.1. So that's 6.01 versus 5.1. So over 20 years, cash was worse. But you didn't take a risk that it wouldn't be. And it's that certainty which is paramount in cash investors' mind. Imagine someone who welcomed pension freedom. On day one, the 10th of April, 2015, bunged £100,000 into a drawdown plan and used a FTSE 100 tracker. The FTSE 100 then was 7089. 1 year later, the FTSE 100 was 6204, 12.5% less. So they paid £100,000 into a tracker, and ignoring the pluses from dividends and the minuses from charges, it lost £12,500. That's not what you want in retirement. Not risk, you want certainty. You want your money there when you decide to decumulate it. And it's all very well to say keep calm, let it carry on, let it go over 60 years or 100 years when shares always do better. And we haven't all got that length of time. And of course, you're paying someone to manage it. Why? What do they do? So I think all financial advisors should be experts in cash, particularly if they deal with retired people. And many don't realize that actually SIPs, your self-invested personal pension, can be in cash accounts. Not cash funds, they're a rip-off completely, but actual genuine deposit accounts. No tax would be due or deducted on those, of course, at all. And you can find cash funds at Investment Sense, there they are. You can see 1.8% over a year, 2.2 over 2 years, 2.9% over 5 years. And tell me this, if you went to your IFA, your financial advisor, and said, will you guarantee me 2.9% return every single year for 5 years? They would say, no, I can't do that. Cash does. And all these here, despite some foreign-sounding names, are regulated in the UK and covered by the Financial Services Compensation Scheme. You can put 5 million into, the State Bank of India, but of course, if the bank fails, you only get £75,000 covered, so you have to spread it out. That's harder work and it dilutes your return, but at least it won't go down. Now, my research looks at the past because we only have data from the past. The past, we often say, is no guide to the future. That's certainly true in financial services when it comes to judgments and human interactions. But, my real interest, I have to say, is numbers, maths, and physics. And in physics, in real science, there is an assumption that the present moment and the present place is actually typical. Not unique. And as Niels Bohr, the quantum physicist, said, predicting is very difficult, especially about the future. But if data from real events shows that cash over any 5-year period from 20 years was, on average, randomly, better than a tracker, it has to be taken seriously. And I'll just say it again, no one has seen this data before. No one. No one has analysed it before. It is new information, and everyone, or no one, I should say, should ignore it. Now, before I leave cash, how's the time going? Am I late? Are you all getting bored and wanting to leave? Not quite. So I'll carry on. One more thing, premium bonds. I'm a great fan of them. If you can afford the big amount, if you can afford 50,000, and a lot of people do, all the money in premium bonds earn 1.25% interest. It goes into a prize fund, it's divided up, tax-free. The chances of winning is 1 in 30,000 for each bond each month. And that's why wealthy people, half the premium bonds in the country are owned by wealthy people who have at least 30 and more like 50,000. These figures actually are 6-7 months old, so it's even better. There's more in the big ones now than there were then. Now, of course, these are averages. You won't win every month. You might win nothing one month, 1 the next month, 3 the next month. But it will average out, because you've got 50,000, it will average out at about 3 prizes every 2 months. Mainly, there'll be £25 prizes, but that is tax-free income coming in. Now, forget about the £1 million prize. There are 2 of those. But even with the maximum £50,000 bond, £50,000, the maximum, you would win the £1 million once since humans started wearing clothes. That is a long time. And when we started burying the dead and painting in caves. Oh, and when we stopped having sex with Neanderthals, I mentioned that earlier. And if you had 1 bond, you would be lucky to have won £1 million twice since life began on Earth 4.8 billion years ago. So have 50,000, pay higher rate tax, and premium bonds are a good way of salting away money, and trust those wealthy 700,000 people, 850,000 people, I should say, who have already got that money there because they know it's a good place for their money. And of course, if you're lucky enough to pay additional rate tax, or to be in that band over £100,000 income where you pay 60% tax, then they're particularly good. So, my final thoughts. There are the odds, premium bond odds coming up. But the slides are available if you want them. Just let me know. My final thoughts. Never invest in something you don't fully understand. Remember that risk goes both ways, and it doesn't guarantee reward. If risk guarantees reward, then it wouldn't be a risk, would it? Risk means you can win more, but you can lose more. That's what risk is. It doesn't guarantee anything. It does not mean reward. Then never invest in something you don't fully understand. They're in the wrong order for some reason. If you do invest, keep charges low. And I'll just say this, but I won't go into the details. Never pay for active management. And apologies to those people here who do all this. It generally doesn't pay. Consider cash. And I don't say everything should be in cash. Particularly, I can see there's some younger people here, younger than me. Most people are, but younger than me. Consider cash. And, of course, get well-qualified, regulated, professional, independent financial advice before making any decisions. And if all that seems a bit complicated or a bit depressing or a bit frightening, just ask yourself this. Why bother? Why not just spend it? There has to come a time in your life when there's no need to accumulate any more money. You're the lucky generation, many of you here. Spend what you have while you can enjoy it, because there's no point in dying rich. You'll just put another smile on George Osborne's face. Thank you very much indeed.